So, accumulation phase. This is a pound 5-minute chart. As you can see, the market's then dropped. So this bar here is a sign of weakness because it's taken out this previous low. Okay, but look at this bar. This bar is a down bar, narrow spread, close in the middle. Volume's really, really high. And again, the next one is dropped out, dropped down on probably an average spread, close off the lows, and the volume's still quite high. Now, the next bar is up, and then you've got another down bar which has quite high volume. Okay, and that shows that there is more buying. You look for the down bars initially because you've had a down move, and don't worry too much about the up move, the up bars, because even though they're up on low volume, that's stopping volume right there in the background. You know it's stopping volume because the market's now starting to go sideways. Okay, so what I want to show you is how they accumulate. So take this after this this high volume down bar closing off the lows. Once that's happened, that's normally where you take account. So you got your first high following this bar and your first real low, or the lowest low. I've drawn the lines across there. I'm not saying that you should do the same, but that's how I've done it. And all I want to show you basically is that sort of corkscrew effect where the market is churned up and down whilst they accumulate. Okay, so they will sell into an up move in order to cap the top end of prices to keep them in a narrow channel whilst they accumulate. So you've got strong bar. This bar is up, so I'd say that was strong. You've got strength in the background, not weakness. That's a strong bar. That's a strong bar because it's a response from that down bar. And then you've got another one there. Next bar is strong. And then you've got...
Can you just go a little slower?
Sure. I got two sets of these to go through today. So I don't think I'm going to make it, but... Okay, so bar A, okay, that's basically your selling climax, stopping volume, but it happens over three bars, although the first one is actual weakness. And then the response for that is an up bar. Even though it's up on low volume, you can discount that as being a weak bar because you've got strength at point A, not weakness. Okay? And then you've got another down bar. The volume is then increased, so it shows that there are buying on the downside. Next bar is up, that's positive. And you've got another down bar with a fairly narrow spread or range. Volume's quite high. It's quite good. So they're actually buying. If you can see, when Tom says that when strength appears, it will appear on down bars. You can see that all the high volume bars are all down bars. Okay, that shows you that they're buying. It doesn't appear that they're buying to an outsider. It just appears that the market's going sideways. But you know, you can actually see that they're actually buying more than they're selling. Okay, and they will be selling into that, but they'll also be buying more than selling, and that's what the accumulation phase is all about. It's if you're accumulating, you don't want to give the game away, so you will sell as well as buying, but you'll end up net buying more than you're selling. But you'll do that. You'll sell as prices rise in order to knock the prices back down again.
The fact that it's closing the lower part of the bar so low, it almost feels like there's more selling than buying on those.
No, because we have to assume that after a down move and you've had this stopping volume, the market's going sideways, these down bars on quite high volume must represent buying because the next bars are up. No? If you've got a down bar and high volume and the next bar's down, then you have to say, well, that's probably weakness because the response from that is lower prices, not higher prices. If you've got a down bar and quite high volume and the next bar is up, you have to assume that that previous bar must have contained more buying than selling because why would the next bar be up? Okay?
So it's the background.
It's the background. You got your stopping volume at point A, and the market basically goes sideways, and then you're just looking for subtle clues as to which way you think the market's going to go up. Now, as it starts to approach this 149.78, you have actually got a low volume up bar. But look, the next bar is a down bar, closed in the middle with an increase in the volume. So then you would say to yourself, okay, so they're not going to allow it to go above this high because that might attract buyers that they don't want to do. They want to make sure the floating supply is taken out of this currency before they mark it up. And the wrong way to do that is just to mark it straight up because other people will jump in. So they don't actually allow it to go up. But can you see how the down bars have got more volume than the up bars? Okay, this is very, it's a secret way of accumulating while giving the impression that the market's just weak or it's going sideways. And this is why, if you can learn to read the strong and weak bars, it gives you a really big clue. Real big clue. So you can say that's strong, next bar up is strong, down bar, high volume, next bar up is strong, down bar, next bar up is strong, then that's a strong bar because it's an up bar with an increase in the volume. Now normally you'd be looking for testing, but they don't allow that. Okay, so you've got a low volume up bars, one weak bar out of all this lot, you've got another down bar closing in the middle, look, increase in the volume. Next bar is up, that's positive. Down bar, high, increase in the volume, it's not excessive, and then up bar. Okay, then there's a down bar, increase in the volume, then you get a test. And look how you've got to retest back down into this area of point A. What's that telling you? But you couldn't see it before though, could you? But it's obvious when I pointed out, but would you have seen that on your own? See, that's it. So you've got a test. So you've got more strong bars in there than you've got weak bars, but the market's going sideways. And you know it's an accumulation phase because you've got increasing volume on down bars because they're accumulating it. And then what you should see is then once it breaks out, you should see increasing volume on up bars with decreasing volume on down bars. Can you see that? How these down bars, the volume drops off? And whilst they're accumulating, the volume will be increased on the down bars whilst they buy more than they're selling. But they won't allow it to go up above the 149.78 because they don't want the market to spring up and bring in all the buyers that they don't want in there. They want to keep you under pressure, and if you're still short at point A, they want to keep you short because they want to buy. They don't want you going long and forcing the price up until they're ready. And then when they're ready, see, look, you got down bar. Then after this test, you got an up bar with an increase in the volume. Then you got a down bar with a decrease in the volume, and then it starts to go up, and you got the increase in the volume as it goes up. And then as you start to get these down bars, the volume falls off again, and you got another leg up. Okay, so that's what I wanted to show you. First of all, you got your stopping volume, then you got your sideways accumulation phase. But you're looking for signs of strength over signs of weakness, which you can see here because you've got down bars closing in the middle and the volume is high with the next bar up. And then you've got a test. And then you've got another up bar followed by another down bar. And then the market just takes right off. Now, I can't draw one of my lines on the highs here because that hasn't actually worked for me, but I might get one off there. And then I might take that one at the end there. But see, that doesn't always work either, so when it's there you can use it and when it isn't, but I'll go through that later anyway.
Are there any triggers on that accumulation phase that would prompt you to go long at the end there? Is there anything that you say, okay, now I'm ready to go, now it's ready to move?
Well, you can, low volume on down bars, you can say, right, okay, I'm going to take that trade. That one will be a good one. The volume is not less than the previous two, but the previous bar is an up bar. You've got a test in the background, and you've got a down bar. Look how high the low is from the low of the previous bars, and it's closed off the low. What's your downside risk for that? You've got all this buying in the background. You can put your stop under the 149.67. I mean, you're practically, it's a steal. You're practically not going to get stopped out because all the buying is in the background. If you can read that, you can read that the buyers are in control, not the sellers. You've got a down move, then you've got a sideways move, and all the down bars contain more buying than selling.
So you wouldn't go long on the test itself?
You could do. I mean, it's obviously down to the individual. But that would be, what I'm saying to you is that would be probably be a risk, a low risk entry there. See, this one for me has lower highs. But this one, the tables are turned, it's got higher lows. Do you see what I mean? That's what I like. I like to see higher lows in an uptrend, or in just the start of an uptrend. If you get a test in the start of an uptrend, that for me is really good. So that one I'd probably favour over that one because it's got lower highs. That for me is still in a slight downtrend. Even though looking back, I can see the market's strong. It could just come back down and test the 149.67 lows and then bounce off that. I mean, you know it's going to go up, but that one there represents the lowest risk for me personally. That one there, because you've got higher lows, you see. It's in an uptrend. And even then, when it comes up and the volume starts to increase, it then goes down on low volume. So there's absolutely no selling whatsoever. So that was quite a strong accumulation phase there. So, I don't know. Does anybody want to mark W and S on their chart for strong bars and weak bars? Okay, so point A is a S, and the next one, the blue one, that's an S. The red one is an S, and the blue one after that one is an S, and the red one after that is an S, and the one after that where the low is marked 149.67, that's an S. The next one is an S because it's an up bar and increase in the volume. Now the next one after that is a weak bar because it's going up on low volume. Okay, so that's your first W bar. The next one is a down bar, close in the middle, that's an S bar. Now the next bar is up. Okay, so you could say that was an S bar. Next one is a down bar with an increase in the volume, that's an S bar, that one there.
Wait. Back on that one, the up bar, would you have said that was a strong bar and not a weak bar because of the volume? I'm looking at the volume, and the volume is
Low.
low.
But you got down bars on increasing volume.
Gotcha. So that it's the result of that previous bar. And
It's
that's
the
why we're
result.
marking it.
Because the next bar is up, the previous bar must have contained more buying than selling.
Okay.
So that's because you've got the strength in the background, you could discount any weak bars. Those are not no demand bars because where's your weakness? There cannot be no demand because you don't have weakness, you have strength in the background.
I think what I was doing, I was looking at that bar and how it reacted to that horizontal line, and it reacted to that horizontal line as the professional's not being interested in it at that exact moment.
Well, they're keeping it down because they don't want the prices to go up against their own buying.
Right.
You see, once you've shaken the market out, the prices are likely to go up, and any large orders will just shoot it up, and you don't want that. You want to make sure that it is actually strong, and the floating supply is taken out of the market before you actually do that. So that's why they're keeping it, they're capping it. So, yeah, but they're secretly accumulating it while they're doing it, whilst not giving the game away, or trying not to. So where are we at to? Where are we at? That one?
The red one, yeah. What's that red one? The next one.
This one.
Right there, yeah.
Okay, so that's a down bar, that's an S bar, because it's down bar closing off the low, the volumes increase over the previous bar. That sends the next bar up, but it's closed in the middle, so that's not such a strong bar. So I'd say that was a weak bar there. That blue one closing in the middle is probably a weak bar, because the response from the previous one is not as great as the previous ones, which were closed near the high. You see how these up bars, even though they're on low volume, are nearly closed on the high? Okay, but that one isn't, it's closed in the middle, so I'd say that was a weak bar, so that's a W bar. Then as the market comes down, the spread of range is still narrow, that's a strong bar. And then you've got a test, that's a very strong bar. Now the result of that test is a wide spread up, or an average spread up, close on the high, that's a strong bar. And then the next one is strong, because it's not making lower lows, it's making higher lows. Closing off the low. Now the next blue one, as it touches that 149.78 level, that one there, that's a strong bar, because it's a result from the previous bar. And then you've got a breakout bar, which is that one there, increasing the volume. And you've got another one, so those are strong bars. That's potentially a weak bar, so you'd have to say, right, I'm going to have to keep my eye on that, see how the market responds. Got a little bit of selling on that one because it's a slight increase, closing in the middle. Okay, now the next bar is an up bar. So I would say that was a strong bar, potentially weak. Now that's potentially weak and that's potentially weak. But then it's coming down, these two bars are down on low volume, so those are strong bars. Okay, so that can't be a weak bar because it's a result of that previous bar. And then these two bars are down, I think those are the two. So those are like average volume and not excessive volume or anything like that. So you could say technically that those two were a test because they're narrow spreads, one of them's close in the middle, although they're a bit higher volume than you'd like. Now the next bar is a wide spread up, that's strong strength. And you've got another wide spread up, it's taken out this high, this old top in the background. And then you've got a narrow down bar spread, a little bit increase in the volume above the average. So that's a strong bar because the next bar is a wide spread up. Now that one has the potential to be weakness, that very last one, but it's not necessarily an upthrust because you've got this strength in the background.
Sam, I would get, maybe others are getting this, but I would see weakness here. I would have gone
There.
long here. I would see, you call some potentially weak bars there. There's looks like a no demand and kind of a downtrend.
That.
Yeah, correct. I would.
What's the response to that, John?
Well, it's a down bar, but it's very tiny range.
So what would that tell you?
Well, a narrow bar typically tells me something's going to reverse.
So how much emphasis then would you place on that bar? Would you short on that blue bar? That one
Well,
there?
I might have shorted at the close of that blue bar,
So where would you be with that bar then?
and then when I saw the next bar, I typically would have thought, well, it's down. But you're right, it is extremely narrow on roughly average volume, so something's
Not
Right,
right,
yeah.
is it? Something doesn't add up.
yeah.
So what's in the background?
Strength is in the background.
So then how would you go back to those two bars and interpret those two
So
bars?
what you're saying is when you see a little anomaly, like I'm pointing out, really what you have to, your bias has to go back to where is the real strength here. And the real strength is at point A, even though there is weakness at 450 or so.
That's not really those are not really that weak, because those bars are not as high as these bars. They're not excessively high volume up bars. They're just above the average. They are, yeah, they're high. But you've got an accumulation phase and you've got strength in the background, so you place less emphasis on that. That's why there was no response from those three up bars. Does that make sense to you, John?
That makes good sense.
So because you've got the strength in the background, the overall picture is an accumulation phase, they're unlikely to be any negative response from any increase in the volume as it approaches a previous top. Because the market, the work's been done in the background, so that's why it breaks through it. They just push it. They know it's wrong. They override it straight away. Any signs of weakness, when you've got strength in the background, is going to be quickly overwritten, and that's what you have. That's why you've got to be so careful.
That makes sense.
Okay,
That was terrific.
you like that?
Yeah, that's good.
See, that's where you want to be.
Yeah.
Right? So, okay, again, accumulation phase. You've got short, sharp shakeout. Okay, you've got quite high volume on this down bar, close in the middle. Now this is AT&T 1 hour. Okay, so then the market goes up. Now it appears to be an upthrust, but it isn't. The reason why is because we don't have any weakness, we have strength in the background, so that cannot possibly be an upthrust. Now you can see that the market churns. You can see high volume down bar, high volume down bar. And don't forget it's not an upthrust because there's no weakness. Now you've got two down bars. That's a big sign of strength just there. You've got a fairly wide average spread down, closing slightly off the lows.
What you use for your low limit?
I probably use that low there. So it's that high, that low, after that. It's easy to do in hindsight, but I just wanted to show you what it will look like when it appears. So all I want to show you is the churning, the corkscrew effect, and then you've got the breakout obviously, but you can see that as you've got increasing volume on down bars, it bounces off that line. So you just take basically the first intermediary low, because it's making lows. These are all joined up, but is that separated by those two lows there? So you've got test-like bar. You see, you've got buying on that down bar, then you've got the next bar up, and then it comes down. So this low is separated from these low by these two these two up bars. So that's why I've taken that, and that's the first up bar from where the responses come off. So it's gone up, it's made a high, and then it's come down by 2-3 bars. So then I've isolated that high, and I've isolated that low, because this low is separate from these lows, which are higher than the previous lows. So I've taken that low, and I've taken that low, and the market's churned basically in a corkscrew sideways. But if you look, you've got no weakness on that bar, you've got buying on that bar, you've got buying on that bar, you've definitely got buying on that bar as it approaches that low. It then bounces off that, you've got more. You've got down bar there, which has got increase in the volume, and then you've got I think my pen might be running out of dead. Yeah, I'm running out of power on that, and if you haven't, I use this for to determine the strength of or the thickness of the Canadian saw. Not for pointing it like that.
That will burn a hole in the screen.
Or this. This is the red button.
Be careful, yeah.
Okay. So you definitely don't want to look in one of these. So you've got high volume on this down bar, and it's approached that low, so there is buying. The next bar is bounced up. Okay, then you've got more buying on that down bar there. Then you've got low volume on that down bar there. Okay, so and then a little bit of weakness as it closes on that session. And you've got a wide spread down. There's no follow through. It's still strong. And then they drop it again. There's no excessive volume. And the next bar is up. And then again they drop it down. There's quite high volume on this down bar. Okay, so that shows strength, not weakness. Because why would the close be on the high instead of the low on that high volume bar there? And then they drop it down. It's on low volume, less than the previous two. And then you've got a level bar there, or slightly down. And the response is it just goes up. But you've got the shakeout, which is your stopping volume, and then you just look for high volume on down bars. Once you've got the strength in the background, you're not thinking about weakness. What's the point? You know, you're following the wrong track. So you're just looking for evidence of accumulation, which you can see here on this stock. And then it just bounces up. And, you know, there's your profit. So, and again, they drop it down on the top of this line now, and the volume's quite high. So that's what I wanted to show you. Is you've got your decline followed by your stopping volume or your shakeout, and then it corkscrews up and down, and that's how you can tell when a stock is under accumulation, or anything else for that matter.
Something how they respond to those intermediate highs and lows. That really responds to that.
Yeah, well, that goes back to you in your support and resistance trading, doesn't it? Because a lot of guys will have their limit orders at the bottom, and they might have short orders at the top, and all the rest of it. And they'll just be looking for like that small fluctuation in the price. So that probably adds to the volume.
That nice wipe off spring right over here before it takes off.
Yeah. Yeah. Normally you'd expect a wyckoff spring to be around about down here somewhere, which would be around about the lows, or maybe there. So the nearest to a wyckoff spring is that, but that's not a wyckoff spring as my understanding. That's more like a wyckoff spring, what it would look like, but that should be down here.
St. Prudent spring.
Yeah.
St. Prudent lines like that.
Right.
Call it spring.
Okay. Okay, so this is DD, which is DuPont. You've obviously got a distribution phase, but you haven't got your buying climax in the background at that point. So that shows you should now have quite high volume on up bars. Those two are weak. It comes down. It's kept in a narrow channel whilst it distributes, and that's a daily basis. You've got supply swamping demand on that bar. Notice that I haven't called it an up thrust. When it comes down, it's kept within that narrow channel, but you should have quite high volume on up bars, which you have there on those two. That really marks that's really your biggest clue. So that's your distribution phase, and then the market will just come off from there. So if you ever see the market going sideways after it's gone up or it's gone down, then you just mark a high and mark a low. And if it stays within that channel, then you can see that it's under either accumulation or distribution. And then if it's under distribution, you should have high volume on up bars after an uptrend. If it's after an uptrend and it's up, then the emphasis will be placed on weakness, not strength. And if it's after a downtrend, then the emphasis should be placed on strong bars, not weak bars.
Wait, could you say that again? Could you say that slower?
Okay.
Say that a little bit slower, what you just said about, start back where you talked about distribution. If it's in distribution, we should see
Okay.
high volume.
If you basically have an uptrend, I mean, ideally you'd see a buying climax if it represents the distribution phase. Then you'd have some sort of buying climax or high volume on up bars with the tops being capped. And then if you see that, you can then after that take a high and take a low, and then you can, look to see if it's got high volume on up bars, but it's being kept within that narrow channel. Then you can say, yeah, they are selling into every time it goes up towards the top. They are selling into it, whilst just keeping it sideways. Neil.
So, is this, if I'm understanding you correctly, this is just the flip side of strength in the bottom?
Yep.
The bottom you'll have higher volume on
Down
down bars,
Yeah.
and here you have the higher volume on up bars.
Yeah, and once it's broken out, then you should have increasing volume, but not excessive volume on up bars, followed by decreasing volume on down bars. I know that sounds confusing, But initially, you've got to buy it whilst not putting up the price against yourself. And then once you start the markup phase, then it switches to increasing volume, but not excessive volume on up bars, followed by down bars on low volume. And the flip side is this: when they're distributing, you'll get the high volume on up bars. They'll keep it within a narrow channel in order to try and bring in buyers, but they'll secretly sell it into up bars. And then once they've completed that phase and then they start to mark it down, you should then start to see, after this distribution phase, increasing volume on down bars with decreasing volume on up bars. Okay, and that is Wyckoff.
But here, if we'd be broken going up, because remember, you're saying that you have increasing volume on up bar. You come into a resistance, and you have increased volume on up bar. You're worried it's going to go through.
Right.
Yes.
That's not a strong bar, because you've got high volume. You've got this down bar, which has got quite high volume. You've got up bars, which have got high volume. But look, that's a false move. That's a trap up move, because look at the next bar. Next bar is a widespread down.
Okay. So without the next bar, you don't know it's a trap up move. You could say, well, we were having increased volume on up bar. We're going to cross that resistance.
Yeah, but then you have to say, well, is it going to test this high of 46.65? That's why you don't go in on this bar. You wait for it, and if you've got a test there, then that's your entry point. If you don't have a test there, which you don't have on this one, this is why you don't go jumping in. You've got to wait for confirmation, you see, and this is why I try and show you confirmation. Because otherwise, you know, I mean, that is a trap up move. They've marked it up, the volume's quite high, you've got, these are weak bars, you know, that's a down bar, quite high volume, and then you've got an up bar, that's on quite high volume as well, and the close is very close to the close of its previous bar. Okay, so, you know, that's quite a weak bar. That's, if you were looking at candles, that would be an engulfing candle. Right, and then that's a weak bar, because look at the volume. And then next bar is down. So that's a trap up move. But you wouldn't know that until this bar here, and that's why you don't go marching in. That's why you wait for confirmation.
Do you short on that after that full trap move? Would you short on that red bar down right after that?
You could do, or you could wait for no demand. You could even short on that one. I think that is no demand. Yeah, that's a no demand bar. So you could wait for that one, or if you're aggressive, you could take that. But it all depends on your own personal. I'm not telling you how to trade. I'm just giving you ideas, and you know, my objective here today is to just show you how strength and weirs appears, how the supply and and demand filters through a chart into strength and weakness, and what happens afterwards. How you trade it is up to you. I can't tell you that. So, but yeah, you've got quite a lot of activity right on the top of this trend channel, and because you have had a slight uptrend and it's in a distribution phase, to be honest, I would be very sceptical of any further up move of that. I would really be looking for a down move, but once it's been confirmed. So you've got a distribution channel, you've got weakness right at the end, you've got a trap up move with the next bar down, and then it comes down, and then that's your entry point. But you've already missed what, 45, 2.5 cents. You've missed five points on that move already. But is it better to miss 5 points and then catch another 5 points, or then take the risk of, you know, being caught short, or, you know, see what I mean? You've got to wait for confirmation. That is definitely a top reversal, so that's weakness. That tells you that is definitely a distribution channel, because that's a trap up move. Next bar is a widespread down. That's a top reversal, and then the market just starts to make the lower highs and lower lows. And then right at the beginning of the following day, because this is a daily chart, so what we're looking at a month. So that's the opening of the following month. We've actually got quite a narrow spread on a really high volume on this up day, and then you've got no demand to follow. So it's fairly obvious that it's still weak and it's going to just come right off. So, but the distribution phase with the corkscrew, which is the opposite of the accumulation phase, is what I wanted to show you.
So seeing that distribution phase up here at the top, or again, when that trap up move is,
yeah,
we're on a daily, so we could drop down, say, to an hourly.
Yeah, you could do.
Do an hourly, or even a 2 hour.
That would be littered with no demand there on an hourly chart or a 15-minute chart.
And then that could get us into that. That could get us into that short
Yeah,
position a little bit quicker.
definitely. So, but I just want to point that out to you so that when you see it, you'll know exactly what it is, and you shouldn't be confused.
So we got the reverse. In the distribution phase, we're looking for high volume up bars.
Yeah, closing off the high.
Closing off the high. And when we're going down, the weakness is appearing, we cross that support,
Yeah.
that little area there. Then we're looking for high volume on down bars.
Increasing.
Increase volume on down bar, and low volume on up bar.
That's right. Yeah. That's basically what you're looking for. But when you get excessive volume on down bars closing in the middle, then you have to assume that another force has stepped into the market. But as long as you don't see that excessive volume on those down bars, then you know you're okay. Because otherwise another force has to come into the market and stop that down move. Any questions, Brittany? You looked at this all day yesterday. Okay, right. Different theme. In an uptrend, any signs of weakness should be quickly overwritten. Okay? So I've taken a low and I've taken another low. So as you can see, you've got the trade guide has come up with one indicator and it's come up with several red indicators, but we're in an uptrend. Okay, so in an uptrend, you place more emphasis on low volume on down bars, such as you have there, and increasing volume on up bars with decreasing volume on down bars. Can you see how that's a fairly average spread up? Increasing the volume, but look, next bar is a down bar. Okay, actually that's not correct because that's an up bar, isn't it? So let me see if I can find you a better example. I've actually got a chart which I've created myself from Rolo Tapes 1910 book, the Studies in Tape Reading, and I can actually show you really well on that chart, which is basically a tick chart. But what is this? This is AA 15-minute chart. Don't really have, see that's an increase in the volume on an up bar, and that is, but that's a down bar and the volume is a little bit high. But then the volume is up on the next bar and you've got a test bar on that one. It doesn't really, then you've got that strength right at the end of that trading session, and then next day is a widespread up. But you should have a test almost immediately to follow, which you don't know. So let me see. Right, so these are two strong bars, they're down bars, fairly narrow spread. You've got an increase in the volume on this up bar, and you've got a decrease in the volume on that down bar, and then you've got an increase in the volume on that up bar, followed by a level bar, and then you've got an increase in the volume on that up bar. Can you see that? You've got those three, they're up, more or less up bars, that one's level, and then you've got a down bar. Can you see how the volume's low? And that down bar, and that's what you're looking for, okay? So, and then you've got another up bar, so the volume decreases, and then those are starting now to look a little bit weak, but you're in an uptrend, and then you've got a down bar with a really narrow spread, increase in the volume, followed by another up bar. Now we're coming to the right to the close of the session now, so there'll be unwinding of positions here. So that's the next day. So right at the end there, you've got a little bit of weakness that's just come in right at the end of the session, and then you've got that bar right at the end, which is a low volume up bar. Okay, so but you've also got a down bar on this quite high volume, so you want to be real careful of that. Even though you've got an increase in the volume, but it's not excessive. See, the volume on that up bar there is not excessive, but the volume on that down bar is quite high. So it comes back down, increase in the volume, closing off the lows, and you've got an up bar with a slight decrease in the volume over the previous bar, and then they bring it back down. Its volume's less than the previous two. Okay, so then it starts to retest there. So you're really looking for increasing volume on up bars with decreasing volume on down bars. You're not always going to get it as you should, because no market's ever perfect. But that's the kind of scenario that you're looking for. Okay, so, but in an uptrend, you ignore all these signs of weakness. So like that one, that one, that one, that one. Because every time you say you've got that weakness, look, it's tested immediately. See, you've got strong bars almost immediately. Got that sign of weakness. Where's the follow through? There is no follow through. Right at the end, you've got a sign of trade guide has given you a sign of weakness, but look, that's buying right at the close, and the next day is the market shoots up. So in an uptrend, you ignore the signs of weakness.
Is that red bar?
That one.
No, go back a little bit more. Back. Yeah, there. Is that? Would you consider that absorption volume because you have some old highs there to the left?
Yes, you could do. You could draw your line across there. And you could say, yep, they've marked it up through probably rapidly, but it's the result of that. You could say, right, okay, that's potential sign of strength. next bar is down. So what's the result of that? The market does not decline any further.
There's a low volume test there. Next bar over, the next one over.
That one?
Yeah.
Yeah. You see? So if there was any weakness on this bar, there's no follow through. That's why you don't go jumping the gun. You always wait for confirmation. And that tells you that yes, that was definitely absorbing any short selling that was on that high. Okay? Again, support and resistance traders who can't read the volume are probably uninformed. I mean, you're in an uptrend. Why do you want to go short? Who wants to go short in an uptrend? You know, you want to give your money away. So yeah, if you've got an old high, and in actual fact, if you draw a line across there, it's bouncing off it, isn't it, Janet? So really, if you drew your line across there, then you'd be buying on there, because it'd be accepting and supporting that high of there. And again, there it does, it breaks through it. There's no selling pressure on that as it comes back down, but they have to test it to make sure the market's still strong. Because any change in market conditions, they would have to then reconsider their positions.
You go down time frames where this has, or the upper one has no effect on the lower one.
For example, 60
Well,
minute
if you're doing daily and you're down doing 5 minutes, you know you could be going all over the place, but this is trending one way or the other.
Well, don't forget, the daily chart will give you a much longer term time frame or a
Right.
point of view than a 5 minute chart. But I don't think it would be
Is there
so.
like a half hour that corresponds to that?
Well, you might have a 5, a 15, a 30 in a daily, for example. Or you could have a 15, a 30, an hourly and a daily, for example. Something like that. But you want all the dots to line up before you start thinking about, you know, making a decision.
In all time frames.
The time frames that you're interested in, for sure.
Yeah.
Because they're not always going to tell you the same picture.
Okay.
You might get a sign of weakness on one chart and it may be countermanded by another chart.
Yeah.
And that's the problem with looking at multiple time frames, is that you can get a conflict of opinion. So then what do you do?
Yeah. That's what I'm finding.
Yeah, you will do. That's why I stopped doing that. Because you'll say,
How do you do it?
I just choose the time frame where I think the best and most reliable indicators appear, and then I just trade that.
Do your time frames change for different equities or futures, whatever you trade?
No, I just tend to, I'll look through a chart. I mean, I'll start off on a daily chart, look what the overall picture is, then I'll drill down to a 60-minute chart, see what the overall picture is, and then I'll just drill it down to 10 or 15, which I'll trade. So that's how I do it, but I also keep my eye on, initially, on the bigger term picture as well. And sometimes you have to go back and look at it, check it out several times during the day. You know, just to see what because the picture will change at some point as forces move in and out. Because these forces move in, they take their investment choices, and then, you know, they'll wait to see what the reaction is from that. So, I mean, they do the same thing. They'll make a move, and then they'll step back and see see how the market reacts to their force of buying or selling or whatever. So,
Let me ask you a quick question. Maybe you're going to be talking about the time frames later, but one thing I seem to notice when a trend is in place, and again, this is mostly DAX-ish, but if I'm on too long a time frame, I'll just get, as I said before, solid red or solid green, up or down. If I'm on too low a time frame, I get this whipsawing red, green, red, green, red, green, red, red, green. And it seems like for any given day, usually it's got a personality where if I can tune it in to the right, now I'll go from 2 minute, 3 minute, 4 minute, 5 minute, 6 minute, get all very close together. And at some point, it'll be mostly one color, but there will be little flecks of the other, which tend to be the no demands or the tests.
yeah.
Is that a reasonable thing to do, or am I making stuff up?
Well, I've been looking at DAX recently again, and I think a 15-minute chart is quite a good chart to look at. It's a slightly longer term view, but you get really good signals off it.
Okay.
Really, really good. I mean, especially when you start getting the close very close to the close of its previous bar. And if I have time, I might show you, the longer term time frames, even on the Bund, which is quite good, you need to look at a longer term. Because you're just going to be, like you say, whipsawed, you're just going to get your stops taken out. But, I've always thought that the longer the time frame, the harder it is for them to whip you. You know, on a shorter time frame they can do it, but on a longer term time frame it would be much harder. Because other traders would see that and they'd react to that and punch them.
Now, is there any rule of thumb as to how often the the personality changes. I mean, as you know, late last summer, everything was looking real good and even easier for me to trade. Then it got real crazy, and you had an unhappy DAX experience as well, and left it for a while.
Yeah.
Now it seems like you said, like every 3 months, every 6 months. Is there any like seasonal variation in what seems to be?
I've not noticed any seasonal variation on index futures, but you're probably going to get times where the summer, for example, I mean after May, after this month, the market may go quiet because people will probably go on holiday, because there is a saying, selling may go away, and then they come back after the summer recess in September, and then pick it up from there. So maybe you've got a lull between May, but then that presents good opportunities as well. You know, it just depends on, you know, you are essentially self-employed in this, and it's down to you when you work, how long you work, how much you make out of it, and then what you do with that. You know, so it's good to have good breaks from it. You know, so you just, if you get too embroiled in it, then your perception of it starts to change. You don't want it to be like a chain. You want it to be something that liberates you and gives you your freedom, not something that you're like a chain gang or something like that. You don't want that. So. Okay, so the flip side of the previous chart is that if you're in a downtrend, so in other words, if you're making lower highs, then any signs of strength which appear should be quickly overwritten. And as you can see, you've got a potential sign of strength there. There's no response. The market quickly marks itself down again, makes a lower high. Then you've got another, not quite sure what's that, it's stopping volume, but that's not correct anyway, because the volume should be something like that, not like that's wrong, just ignore that. That one's probably something similar, which you'd obviously ignore because you're in a downtrend. If you're making lower highs and you've got weakness in the background such as you have here, there's no response to any up move, then you just basically ignore any signs of strength. So if you get testing, if you get increasing volume, down bars closing in the middle, the market, if it then continues in its downtrend, it's quickly overwritten. So in a downtrend, you ignore any signs of strength. Obviously, further down, you start to get increases in the volume, and then the accumulation phase starts to pick up. And that's on that. I think that's AA Alcoa, if my memory serves me correct. So yeah, but in a downtrend, just don't even think about signs of any strength or anything. Wait until the volume really starts to stand out. I mean, this is the difference. I mean, if we all stood up, we'd probably all make volume bars look like this, and then if you invite a couple of basketball players in, they'd look like that. So that's the difference, you see. Until you start seeing basketball players, amongst the crowd, then it's in a downtrend. You just don't even consider going on because you'll just get, you get pretty wasted on it.
You go to that, before that line is that bar there.
This one.
Yeah. So if you're sitting on that day and you see that, it almost looks like it could be a shakeout that needs to be tested, or at that point the volume is pretty high. What would you need to see there to feel that the trend is starting to change after that? I'd
like to see that in the background, and I don't see it. There's no shakeout. You've got a topping phase out. The market's in a decline. Look at the response from that. That bar there is the one you're talking about, isn't it?
Yes.
Look at the response. What do those two bars tell you?
Very weak.
So then how would you interpret that bar? Could you interpret that bar as a strong bar?
No, it's going to go back.
So
there's no response.
There's no response. So if it's in a downtrend and it's genuinely weak, there will be no responses to any signs of strength. That's why you ignore them. I mean, these are concepts that you haven't really... No, I haven't spoken about anything like this before.
Right.
And this is stuff that you've never heard, hopefully, before. So what I've done is I've gone through some of Tom's stuff and I've tried to say, right, what can I present to you that you've never seen? What can help you that you've never seen before? And that's what I'm trying to do today. It's hopefully an advanced workshop. So, okay, Bank of America, 15 minutes. Okay, so in a downtrend, again, any signs of strength should be quickly overwritten. Okay, so I'm not referring to this, obviously. The specialist has tried to reaccumulate, or interests have tried to buy, but the result is that it's just been too weak. So they've made an attempt back here, so the market's still in a downtrend, So you've got these down bars closing off the lows on low volume. But look, the market's in a downtrend, so you have to ignore them. Okay? You have to ignore these down bars on low volume because they're making lower highs all the time. Okay, so you don't want to be buying these. You don't want to be buying down bars, even if the volume's low. Doesn't matter. These are in a downtrend. There's going to be no response. Look how these up bars respond to these down bars and closing in the middle. Look, an up bar, a low volume, next bar is down. A low volume up bar with a fairly narrow spread, next bar is down, and so on and so forth. Look how it tries to go up, it's on low volume. So you have to ignore these down bars closing in the middle on low volume if you're in a downtrend. So try and establish the trend if you can. The way I'd establish a trend is I take two moving averages, one of the high, one of the low, and I use a 2, the period is a 2. So it follows, it will follow it fairly closely, so then you can see fairly quickly and obviously whether the trend is up or down. And if you can see that the two moving averages, and it will be above the high and the low, like this, like so, that's the high moving average and the low moving average. It will follow this fairly sort of tightly, and then you can say, right, if you get no demand and it's sloping down, then you can say, right, okay, that's a short. But that's a good way I find that. I can actually show you that later.
Is there an opportunity to short on that chart? Do you see areas like as the downtrend is?
That there, that one there. It's going up on low volume, struggling to go up. There's no stopping volume in the background. I think it's in a downtrend, and it's just any response to the upside is just, you know, it's like I don't know, it's like an athlete who's been running around a track all day, and then, you know, then you ask him to do another race, he's going to be wasted, and that's it. You see, there's just no response. You've got these down bars on low volume, and there's just no response to it. It's just ticking down, ticking down. Even though they're closing off the lows, you would imagine that would be strength. But then the next bar is down, next bar is down, next bar is down. And as it tries to go up, look, the response is just weak, feeble.
As I see this, generally the volume is continually coming down
Yeah.
as the price is coming down. Is this something Tom refers to as bullish volume? And you can look for something over here that's not on the chart yet to start going back up?
Are you talking about that indicator right there?
Yes.
Right, that indicator there works. I found out how this works. That works by increasing volume on up bars with decreasing volume on down bars. And on the flip side, it would be increasing volume on down bars with decreasing volume on up bars. But I wouldn't place much emphasis on it because I'm not sure how accurate it is.
Well, I was just looking at the total chart where it kind of trend from about 4 bars from where your line, well, where your first line is drawn, the indicator shows. Basically, the volume continues to drop as the price continues to come down.
Yeah, so what you're saying is that this could end up as a sign of strength 6, as a retest
Overall,
into
over
that.
the
Yeah,
big picture.
that could well be. I mean, you can see these two down bars. You see how the volume has increased as it comes now down to approach this low. So that could well be. But from this point, you're in a downtrend. So it may well come down to retest that low and then bounce off up. But the point is that from this bar, it's in a downtrend. So you want to ignore any signs of strength, even though you potentially have this in the background. I mean, this is potentially a sign of strength. It's even got a green indicator on it. But look at the response from that. The response is it goes up on low volume, look, and then it just trends down. So that's why I say that if you've got a sign of strength appears and there's no response to that sign of strength, and then the market trends down, then you have to ignore any signs of strength. Do you follow? You know, unless you're a generous person, of course. Okay. Strongest bars to be found. Okay, now this is one that you haven't come across before because I know. And the paper that I would normally read off is actually in London, so strongest bars to be found is if you've got a down bar, okay, close on the high, slight increase in the volume, and then you've got a second down bar, close off the lows, close near the highs, volume less than the previous two. That's one of the strongest bars you can have or find. Okay, so you've got two down bars. Okay, you've got two green down bars there. These are actually quite difficult to find. I had to do quite a bit of searching to find these. If you look at that bar that bar is got red bars, so it's got up bars in the background. Okay, this one has an up bar in the background. That one has an up bar in the background. So does that one. So does that one. So does that one. Now that's the only one that doesn't, but that's closing the middle, not on the high. Now that one does, but that's also closing the middle. So you can see that they're not that obvious and they don't turn up that easily. But this is a rare example, and you've got two up bars with an increase in the volume. Okay, so then it's obviously come up past this. There's a little bit of weakness coming in, not much. It's tested in each one. But if you've got a down bar, okay, close on the high followed by a second one with a volume less than the previous two, that gives it more, you place more emphasis on this one than you would say a down bar with, say, the previous bar was up. Okay, so you haven't been taught this in the past, I'm fairly certain of that. Do any of you have the seminar books from the last one? Do you have it on you, Janet?
Oh, you meant
The one that you were given in the last time you were here.
I just have the little one.
Okay, so what you have, has everybody got one of these? Okay, I think most of you have. If you look at the highlighted text, there's some really good nuggets here. So what I'm going to do is quickly look through it. See, okay. Should say strongest bars to be found. There you go. The strongest bars to be found: a down bar, narrow spread, close on the high, volume less than the previous two. Add more strength if the previous bar is down. Did you look at? Did you read that?
I didn't until you just said it now.
It didn't register.
It didn't register.
Yeah, I got it. Yeah. See, you've got to look at this, and then you've got to say, how does that equate to a chart? So, add more strength if the previous bar is a down bar. But how often do you see that? It's not very often. That's probably why you never notice it, because you very rarely see it. Okay? So this is why I've decided to highlight it. And this book is really good. It's got some really good stuff in it. And what I suggest you do is just go through it. Look, and it says, so it tells you the strongest bars to be found. If after a strong bar has appeared, the market ignores this with the next bar down with a close lower than the previous bar, then this shows weakness. Okay, so let's see if we can find one of those. So that becomes then a failed test. Can't see one here, but you know there will be an example somewhere. So down bar, close with the next bar down. No,
but those two bars are together, and they go down, but they come right back up. They close to the top because
That's
you
right.
can't sell it.
Yeah, there's no weakness there. But you see, in the background, you've got two up bars with an increase in the volume, and you've got potentially. That's not supply swamping demand, but the market's gone up and then it's come back down because it's run out of buyers. Okay, so then the market's gone sideways. You've got a test-like bar there, and then you've got a down bar, close on the high, increase in the volume, and then you've got a test bar to follow it. So what I'm saying is that add more strength if the previous bar is a down bar. So that's a test, but the previous bar is a down bar. You give it more strength. Okay, so you definitely want to think about buying on that one. So if you've got two down bars and they're both test-like bars, you've got to place more emphasis on that.
Talked about failed tests last time.
Right?
Would that first green bar be a failed test?
Which one? This one?
Yeah.
That one would be. What is that? That one, yeah, you've got a close equal to the close of its previous bar, and the volume's less than previous two, yeah, and then it comes down, they buy it, and then it's tested again. Notice how it's tested again, because that one failed, then they tested it a second time. Okay, and then they've got no real selling pressure on the way up. But what's in the background? You've got buying there, you've got buying just on the open, you've got very little, you've got practically no weakness on that bar. The market just goes up. You see it then just trends up, hits a little bit of supply on that one, but then it's tested straight away. And that's why I say, if you've got any signs of strength that appear in the market and it's suddenly tested, you have to assume the market's stronger than you first thought. Okay, professionals can see that. It's only the public that can't. So, as you can see, you've got this weakness has appeared. You've got a wide spread down. See, that's not a test. You've got a down bar, close on the high, and the volume's really high. The next bar is down. Okay, supposing that was volume less than the previous two, that would be a failed test. If that was a down bar, close on the high, and the volume was less than the previous two, with the next bar is a wide spread down, then yeah, that would be a failed test. Okay, so the effort is to mark the market up, but the result is that it was weak and it got dropped. Okay? So that's one of the strongest bars to be found. And again, another example, you've got same stock, AXP, American Express, you've got a down bar that's buying right at the close, and then they drop it down, low volume, and then you've got another test. And as you can see, you've actually got 3 down bars. So you've got a down bar, close on the low, and then you've got a down bar, close on the high, volume's less than the previous 2. That's a very strong bar. So you place, that's a stronger bar than if you have, say, according to Tom, then you just have a regular test, which is, say, like that one. So if you've got a test and the previous bar is down, then you place more, you give it more strength. Okay? Okay, again. Okay, this is a test and rising market. So, a little bit of weakness on that one. You've got an up bar, close off the high. It's immediately tested. And you've got the same again, it's immediately tested. So, test and rising market, they are the strongest bars to be found. And as you can see, there's practically no weakness in there whatsoever. Last 45 minutes of the previous day, you've got 2 down bars, quite high volume. Okay, so there's going to be no selling pressure in the market on the following day. Okay? So let's go back to this. Right, so there's no gap up. Okay, so yeah, the highs of the bar should not be higher than the previous bar. Okay, so when you've got a test-like bar, the high should not be higher than its previous bar. Okay, so which you don't have there, and you don't have there. So there'll always be a cause in the background. If you get tests in a chart, you've got to look back and say, what's bringing those tests to life? And what you have here is you've got a shakeout, some sort of selling climax, where you've got a down bar, fairly narrow spread, close in the middle. Next bar is up, doesn't matter about the volume because there was more buying than selling, that's demand swamping supply. And you got another one just before the close. So you would be buying calls on that one. And then, you know, you'd either close out or you just, you know, you wait, the market tests again, it's in a rising market. You've got higher lows. Okay, the professional traders have done the work for you. You know, they're the ones who are committing the capital and risking. They're the ones who are doing the risk. This is why, in order to reduce their risk, they have to make sure the market is actually strong. And that's why they do tests, because they're not gamblers. You know, they're committed to making a profit. They have to make a return on their capital. So they have to make sure that in order to move a market up or to manipulate it up from these lows, they have to make sure that they've taken out the floating supply. They would have committed capital to doing that here, and they want to make sure that they're not going to lose money on that capital. And I'm not talking about those guys who you just saw in that video who have just been, you know, green as, you know, spinach. These are guys who have been around for many years. You know, the guys that you read about in those market wizard books, which I've never read. Okay, so again, strongest bars to be found are tests in a rising market. Okay, the market comes down on low volume, and it starts to go up, and then you're looking for, in an uptrend, you're looking for down bars, low volume, and that one you've got a slight increase in the volume with a decreasing volume on down bars, and then you've got a test there. Now the next bar is up, slight bit of weakness, no selling pressure on that one. What's that? That's still AXP. So you've got some weakness there, but it's quickly overridden. See how the trend continues up after that potential sign of weakness? That could signal start of a distribution phase, but there's no response to that. That's a strong bar. The market then goes up before it starts to top off. But what you're looking for is, again, right before the close, you've got this really strong bar, down bar, close in the middle, quite high volume. Okay, next day it gaps up. Now again, if you're an options trader or you trade your stocks just at the close, you could close out your position on that, but then it comes back down into this high volume area on low volume, volume less than the previous two. It then goes up, starts an uptrend to higher lows, and then you've got a down bar, close in the middle, followed by another test. okay, and then it just carries on up. So that's what you're looking for, okay. You may not always see it, but when you do, that's what you want to go for, and that's a 15-minute chart. Any questions on that chart?
What gets you out? Assuming you were long, and now you're hitting that top, and I mean, in hindsight, we see that it came off. But what would get you out? Let's say toward the top. Is there any sign there? I mean, you have that big volume sign of weakness.
That one.
Yeah, over there.
Yeah, but it's in an uptrend.
It's an uptrend, and then you keep going up.
But what's the response? What's that bar compared to that bar? What's the response of this bar? If that's weak, as Trade Guider says it is, what's the response? What does that mean?
Real response.
It's not a negative response, is
Right.
it?
Yeah.
So then what would your interpretation of that be?
That it's strong. It's going to keep going up.
So you wouldn't be able to sell it at that point then, would you?
Okay, so it keeps going up, and then you have a reversal on the top there. But is there anything about that on top that you would say, okay, time to lock in some profits, or
Probably that one.
okay,
Because you would expect that one to be tested. Okay, it's fairly widespread down, close above the middle. But that bar shows you that one, if there was any strength on that one, it's failed on that one. So that would be the time where you just close it out. That one there. Because it's now starting to make lower highs, you see. The problem with going short on this one, and I estimate that is short sellers on that high, is that it's still in an uptrend. So you're still placing the emphasis on strong bars such as these tests. You see, that's why when you see that, I mean, I've known people who go short on those thinking that they're up thrust, and then they lose money because the market then continues up. And this is why I say you don't take these bars in isolation, but you have to slot them in together as a part of an overall picture. And if you can't do that, or if you don't do that, you are liable to make mistakes, and that will cost you.
so you're really looking at the lower lows and the lower highs to tell you at least the short-term
Higher
trend.
lows.
Higher lows, and then
Lower
on the
highs.
reverse side,
Yeah.
lower highs
Yeah.
to tell you the short-term trend.
Yeah.
And also, there's no rounding over there.
No,
Typically,
there isn't.
You see a rounding over, and that's a really good sign for sure.
Yeah. Yeah. I mean, that could have well been. You see, the thing is that when you've got a margin of 30 to 1, I mean, that gives you a lot more leverage over the ordinary public. And so therefore, if you had have sold off a large block, say there, you can afford to ride it up on a short position at 30 to 1. And your downside will be very, very low because your margin was so big. You see, that's, so they can afford to do it, which the public can't. The public would be strangled if they went short on that one by the time they got up there. They'd also be traders, if there were any shorts on there, they'd be under pressure right up here too. So that's to take out, probably to catch stocks out, flush as many, it's just part of the tricks that they get up to. But definitely, if you'd have gone long, you see, you've definitely got strength there, right at the close. And it comes back down. As it approaches this former low, the volume's low. That tells you there's no selling pressure, and you get a test and rising market with higher lows. That's what you're looking for. You're going to be making money on that, and that's really what you're looking for.
Sebastian, let me ask a question here on this. I guess it's about 1730, the bar we were talking about before. Okay, we see
That one.
Yeah. Well, Trade Guider gives us a down signal there, and of course, you're making the point that there's no real response to that. The next bar is a strong bar. Help me understand why the next bar is a strong bar. Is it strong because it's actually made a higher low? Is that what makes it strong?
Yeah. I mean, if you look at those lows, John, they're all higher.
Correct.
Right? Now, look, let's close off the low. The volume's not excessive. It's just
But
above
it is
the
a down
average.
bar. It
Yeah.
has a big top tail, so there must have been somebody selling there.
It started out as an up bar, as it ended up as a down bar. The next bar is up, and you still got higher lows. You see, this to me, it started out as an up bar, but it's a down bar, okay, and the volume is above the average. So you have to say, right, okay, so that's
the real issue that you're looking at, the response to see, am I breaking this pattern of higher lows?
yeah, which are not at the moment.
Correct.
Right. So in an uptrend, you've got the test, so you're following the higher lows, and you haven't got broken.
Maybe that's part of the Wyckoff cause and effect sort
Maybe.
of thing.
Yeah, maybe.
There would have had to have been a bigger effect if that was really selling.
Yeah. But the thing is that if the trend is up, then you'll see that you play more emphasis on the tests or the strong bars in a rising market, and you place less emphasis on the weak-looking bars in the uptrend, and they'll just keep you in, And then when the trend changes, then you just look for, weak bars in a downtrend, and then hopefully you should. I mean, you know exactly what I'm talking about, John, because you've seen an example. But this is all stuff that will come out in the future, and if I do an online seminar, I'll show it to you, and you can add it into yours. But it doesn't exist at the moment. It's just the moving averages are on the close only, so that's something that will probably happen. So yeah, in an uptrend where you've got higher lows, you place more emphasis on strong bars. Okay.
So what do you use about a 5-period moving average, something short, so you can follow it?
2.
Oh, 2.
Based on the high and 1 based on the low. So you've got 2 separate lines. If you take my 2 fingers as a high and a low, it will go up and it will go down with. It will just basically, the line will just follow the low. And then the high will just follow the high. And then because when you've got the 2, and you can see, it's actually, I find that if you're using a moving average on the high and on the low, when it's going up, it's obvious that it's going up. You see, the problem is that the problem that you have is that you look at a chart and then you might not see anything. You see, that's the problem. Information overload. I mean, some of you seem to be not struggling, but you seem to sort of temporarily forget that you've got to look in the background. It's like you're still taking these bars in isolation. So now I say, well, why not try and make it even easier by just having a simple moving average that when it's going up and you see a strong bar, then that's it. And then you just take the trend. So, I'm just trying to make it as easy for you as I possibly can. But unfortunately, I don't really have a good example, but hopefully I will have in the future. So when you're in an uptrend, then you just place the emphasis on the strong bars. And when you're in a downtrend, you place emphasis on the weak bars. And obviously on this one, you'd place the emphasis on the strong ones. So